Morning, everyone. So, welcome to Trilegal's webinar series. So, very glad to have you all here. Today, we have a special session. Some of you ping me on LinkedIn and ask me what am I doing with respect to a tax session. There's no real justification other than the fact that we're just going to discuss the impact of uh, the budget on the sector that I practice in, which is the technology sector. So for this, I have none other than Mr. Meyyappan, who is a partner with Trilegal Tax Practice. He is someone who specializes in um, tax issues which arise in the tech sector, which makes him the right person to talk about the issues in today's webinar. So, Maya, do you want to just give a brief intro of some of the issues that you spot? Give a brief intro of the budget. What are your initial senses?
Sure. Thanks, Nikhil. Hi, everyone, and thanks for taking time out for this webinar. Today, what we hope to be covering, as Nikhil said, is the key announcements in the budget, specifically focusing on the tech sector. And I think, we'll be looking at what is the impact on the common business models, the kind of, operations and financing structures in specifically in, certain parts of the digital sector, such as e-commerce, gaming, SaaS, crypto space sector. So we'll be picking up some of these in a little bit more of detail and kind of seeing, where have we come from? What are the common sort of arrangements today? And how does the proposals in the budget actually impact them going forward? And I think over to you, Nikhil, for, maybe starting off with the most surprising one that came from the budget.
So I think to my mind, the most surprising one was the equalization levy, the fact that equalization levy is gone now. It surprised me at certain levels. Of course, a lot of clients are very happy. The fact that equalization levy has been done away with most of the items. I think it's remaining for advertisement, I believe. Other than that, it's largely gone. It's surprising to me because of two aspects. One, of course, when the equalization levy was imposed, it surprised all of us. Then there were series of conversations with the government. There were series of talks between India and other countries, including the United States, on how to deal with the sort of not paying of tax by several entities who operate in the digital space, who actually collect a lot of revenue from India, but they don't end up paying taxes. So, but the government always had a very strong push or a stand that local equalization levy is here to stay, and there were multiple discussions on it. So it came as a bit of a surprise. But Maya, do you have any background? Do you have any historic background as to, why we had the equalization levy in the first place, and probably why it's gone suddenly?
Yeah, Nikhil, that came pretty much as a shock. I think I don't think anyone was expecting the
Good shock or a bad shock?
good shock in some ways. I think from a tax policy perspective, I don't think maybe they have gone all the way because, like you said, the 6% levy is still there. If they were being consistent from a policy perspective, they would have rolled back all of it. But I think there's a little bit of geopolitics involved, which we will unpack. So starting with the history, like you rightly said, the way this started was that we've been, so just to give a little bit of context to everyone, we've had two equalization levies passed in India. The first one happened in 2016 when it is a 6% equalization levy on advertising services. Now that was structured as a withholding tax on the Indian companies who pay an offshore service provider for online advertising services. Now, come 4 years later, 2020, it was further expanded and they made it a 2% equalization levy, which covered pretty much all e-commerce services under the sun. Now, the context to this is for a long time, India has been saying that the OECD model of international taxation has been outdated. They've been saying that tech companies which don't have a physical presence because of the way their businesses work do not have a taxable presence in India because under the OECD model, you need to have a agency PE or a physical presence or some kind of physical taxable presence to be taxed on that income. So that's led to a lot of discussion over almost close to a decade now, and we still don't have visibility on where that discussion is going. The way the discussion morphed was that, initially countries said, the Western countries said, no, we don't have The current system works perfectly fine. We don't need to create a taxing right for these tech businesses. Eventually, after the last US elections, the US government kind of came around and said, hey, we can't distinguish between highly digital and non-digital companies. So why don't we just tax the 100 top paying companies and give a right to all the countries where the market is located. So typically in international tax, Nikhil, the resident, the country where the company is located and the country where the payment is coming from used to be the considered also the country where the market is located, and those two were the only ones that were taxed. But because of the business models, where multi-sided business models where you could have companies in one country operating targeting a market in a third country and payments coming from a different place. I think there's been this sort of foundational shift in terms of how international tax has been working. Now, in that context, to get everybody to come to the running to the negotiation table, India as a pioneer introduced a 6% equalization levy, which was at that point in time really lambasted for being undermining international tax treaties, and it was made to to make a point that if you don't agree to our terms, we will impose unilateral levies. Even at that point, not initially, the 2016 one, the US did not push back too much because of the way it was structured. It is a withholding tax on Indian companies, and they felt that's something they cannot maybe want to push back on. But when the 2020 2% equalization levy came, the USTR, the United States Trade Representatives, I think they were very active, and they said this is actually a potential violation. It's it's an unfair trade restriction, and they said they may take retaliatory measures against the Indian government. Now, India didn't blink. Even at that point in time, they continued to press their case for, and they've been very active, in fact, not just in OECD, in signing up to Pillar 1 at a subsequent point in time. But recently, when the negotiations weren't going well or in favor, because while all the countries, so Pillar 1 and Pillar 2, again, just to take a step back, is all this discussion at the global stage has crystallized into two approaches to international tax. Pillar 1 is creating a new taxing right where the companies which are resident, let's say in a foreign country, once they have paid taxes in the country where the payment is coming from and their domestic taxes, any residual income, they're trying to give a right to countries where a market is located, like India, where users are located, where data is collected, for example. So that is Pillar 1 for all the top 100 companies in the world. And Pillar 2 is something that US pushed for because US wanted to raise domestic taxes. And Pillar 2 was meant to have a global minimum tax of 15% so that there is no harmful tax competition or companies don't shift out of the US if they raise their domestic taxes. So the trade-off or the political sort of geopolitics behind this for a few years has been that India wanted Pillar 1. We wanted the right to tax tech companies which are majorly based out of US, and we were willing to agree to Pillar 2 and push support for that. And recently, however, US with the elections and the political scene there, it's not clear who's going to come into power, and it looks unlikely that, irrespective of whichever party comes into power, it looks unlikely that Pillar 1 will go through. And that's important because without US's buy-in, Pillar 1 doesn't really go anywhere because of the way the voting works based on the number of companies that are affected. Majority are in the US. So there is a minimum sort of majority vote or consensus you need for Pillar 1 to be implemented, and that looks unlikely without the US support. So this was the situation when we went into the current budget. In fact, keeping in mind the increased sort of the voice, the louder voice that India has been leading the UN discussions to the extent that even the OECD and US has said, let's keep this Pillar 1 negotiations within the OECD and not at the UN. So we've been very vocal about it. I wouldn't have been surprised if the EL was further expanded in some form or manner. So to suddenly turn around and say, and what is interesting in the budget is if you take a look at the reasons given as to why this has been sort of taken off the statute books, they say that this has been because of compliance burden and the ambiguous scope of the levy. Now, this levy has been around for 4 years, and in terms of compliance burden. It's not any more than OIDAR or GST on digital services that companies have to register and pay in India. Yes, there was ambiguity, and there were hopes that a few years back a comprehensive sort of FAQ would be released to clarify the issues. But that hasn't been forthcoming. So for me, when I look at it, it seems like these were fixable problems, and these don't really seem to be the real reason why there has been a fundamental, policy shift. And if we read between the lines, right after the budget, the finance minister said in a press meet that that the EL, the way it is structured, was effectively passed on as a cost to Indian sort of companies and startups. Now, that is philosophically or fundamentally from an objective point of view, contrary to why it was called the equalization levy, because it was called the equalization levy because they said Indian companies are paying taxes whereas foreign companies aren't, and therefore to equalize and level the playing field, we're imposing a tax on the foreign companies. But if it was passed on to us as a cost, then it's our startups and companies that are bearing the cost. And this was a point that has been made repeatedly over multiple years, and we thought that time for them to listen and do something about it has moved on. But that is one of the reasons what that the finance minister mentioned in the press release, I mean, in the meeting after the budget. And subsequently, they've also hinted that this may be to move along the lines of, in a good faith basis to implement Pillar 1 and Pillar 2. Now, the final thing that, the interesting thing is that if you see the timing, why is it effective as of August 1st, which is a few days from now, the equalization levy is being removed. The real reason I feel is because the United States Trade Representative, there was an agreement between India and the US that for an interim period till Pillar 1 comes, any equalization levy paid will be given as a credit for any Pillar 1 taxes that are payable after Pillar 1 becomes agreed and imposed. Now that interim moratorium from which, during which USTR will not take any retaliatory trade action was supposed to end as of July 31st, after a couple of extensions. So the timing seems suspicious that, for whatever reason, and it doesn't seem like, because had it just been the threat of USTR retaliation, we would have, buckled a few years back. So the timing of this and doing it now and such a big policy U-turn, especially when and if you take a step back, we were doing all of this to get Pillar 1, and Pillar 1 doesn't look any more certain or close to happening. So it seems like a fundamental policy shift from the government's perspective. Hopefully there is some larger geopolitical angle or non-tax trade-off for because of which we are agreeing to this concession in a way. But having said that, from a client perspective, yeah, I think it's a great move. As I said, I don't think the government has gone all the way, because if we go by their reasons that the cost is being borne by Indian customers, that it is ambiguous, and it is causing compliance issues and enforcement challenges. The same thing applies to the 6% equalization levy as well.
So I think it's an interesting thing, right? I mean, so when you say that, if tax were to be rolled back because of compliance, right? I think pretty much the whole of income tax would have to be rolled back, because you all know how difficult it is to do this TCS and TDS. I recently rented an apartment, and in that process, the amount of trouble I had to pay tax was like crazy. I was like, I should not have rented an apartment. It was that crazy. So anyway, it's a funny story. But do you have a sense of how much revenue was collected as part of this, and how much? What is the impact on the exchequer after this is being rolled back? And look, Meya, the other thing is, look, there are a large number of, I'm sure a lot of multinational companies feel that it's an unfair tax, because, and just to sort of point to this, I mean, it's not just e-commerce, right? I mean, it's pretty much any service which is being coming under the ambit of equalization. So there was another perspective from Indian companies saying that, look, there is a undue advantage for folks who are providing service from elsewhere as well. I mean, so how do you sort of respond to that? I mean, do you think that that's going to be another issue that will be discussed at length over time?
Yeah, that's a great question. And in fact, I think that's where some of the structuring opportunities exist, which we may briefly touch upon later during our webinar as well. But I think you're right, Nikhil. I think, see, from a government perspective, it was a few thousand crores. It wasn't a significant amount of revenue. it was increasing year on year as more companies registered and as more operations expanded. I think, however, it was always introduced not as a revenue-raising measure. It was introduced to make a point. It was introduced to bring the countries, for the Western countries running to the negotiation table, and to ultimately make sure Pillar One goes through. So I think from that perspective, I don't think the loss of revenue would hurt as much, but the policy stance on Pillar One and what we are thinking about, that seems a little unclear at this stage. Coming to these, the unfair, level, in terms of unfair playing field, rather. You're right. In fact, I think some of the things we'll be touching upon later when we get into sector-specific opportunities is, we've had the overseas investment rules and the round-tripping sort of things relaxed, right? And typically, it's a very common question for companies to wonder where to run operations from or where to raise finance from. And we'll be seeing maybe a little closer how the pros and cons stack up now after this, set of budget changes.
Yeah, so I think I think folks, what Maya is suggesting is that take your business abroad, right? So it's it's much better compliance. Look, I'm not opining on that because Maya, as you know, there are a lot of people who have flipped their structures abroad and now trying to coming back and they're doing a reverse flip, and that's causing a lot of issues for them, including tax issues, right? So anyway, I think it should also depend on sector. I mean, which sector you want to operate, where you want to go. What are the other conditions that you need to keep in mind when you actually do that? But actually, that brings me to another question on this is largely unaddressed. Do you know what is the reason for this policy change of taxation of foreign companies? Was that actually a real demand, right? So because in any way, if you go to a place like a gift city, there's no tax anyways. You can open a branch, right? So what is the real reason for bringing down the taxation on foreign companies? And look, this is basically conspiracy theory realm, but is the idea that, look, we are scrapping the equalization tax, but now we have some new concepts. For instance, if you, regardless of whether you are in Ireland or in USA, if you have a PE in India, and this PE nowadays is not just fixed place of business, it could be an equipment that you put in. It could be a server that you put in a data center in India. It could be virtual PE. And I don't know what the definition of virtual PE is. Virtual PE technically could exist in someone's mobile app as well, right? I mean, if you just expand the argument, because the PE seems to be expanding from all sides. So are they then saying that, look, then we're going to tax you under the new 35% that's coming in, right? So what is the reason for this? So is it like you've dropped equalization levy, but we may see more scrutiny on the PE front, coming up with new expanded understanding of what a PE is, including virtual PEs?
Yeah, so I think that's another interesting one, Nikhil, because I think there are two ways to maybe explain it, right? One way is the non-conspiracy theory one, is that India for years has been trying to attract investments or operations directly as opposed to through intermediate jurisdictions. And they've been consistently trying to, so they've been promoting Gift City, they've been kind of encouraging, they've been rationalizing taxes, they want more direct engagement. I think as the one way to look at that is that this sort of rationalization is part of that process, because somewhere at the end of the day, a domestic company pays 30%, but a PE was paying 40%, right? So I think that's arguably.
Companies also dropped to 25.
Dropped to 25.
25.
Right. Yeah. 25 for most companies. And then, so the difference is substantially a lot larger. So this could be seen potentially as one of the steps in kind of rationalizing that and bringing it down, maybe comes down over a period of time. But having said that, right, when we look at it from a tech perspective specifically, I think a few years back, significant economic presence was introduced as a concept under the domestic law. And that what they tried to do was create a virtual PE concept where they said if you have more than 300,000 users in a year, or if you have more than 3 crore worth transactions in India, then you effectively create a taxable presence, right? And there was also suddenly in parallel or around the same time the requirements for mandatory localization of certain kinds of data, and this is around the time conversation around data and how valuable it is was kind of peaking in the international tax context. So I think, yeah, I mean, if you look at it another way, yes, maybe and as you rightly said, the rulings, if I look at the trend of the tax rulings when it comes to virtual PE, earlier, when you said server PE under OECD commentary, you needed to have like a physical server, which was pretty large piece of equipment attached to the ground, etc. Yeah, 10 years back, we had the couple of rulings on whether ticketing kiosks are actually PE or not. And they said, a ticketing kiosk is a smaller machine if it's fixed in a particular place and nobody can move it without the installer's permission, it's a PE. Come back to like 3-4 years back, and we have a few rulings where the point of sales machines, which are like attached to a table, etc., become a PE. So if we look at the trend, then you could tomorrow have a mobile phone has more computing power than even a server used to have 10 years back. So are we saying that the difference between a fixed place and this not having a PE is just the fact that it's mobile or not? In fact, there are rulings which say that if there are ships or if there are kind of equipment roughly in a certain location, generally in the territory of India, right, it could create a PE. So we are seeing rulings go down the path where they're stretching the concept of what is fixed, what is permanent, and what is the size of the equipment required to actually create it. So keeping these in mind, I would definitely expect a more sort of attempts to tax such transactions on these grounds. And we are seeing, at least in ITAT and in certain courts, judges are been seeing this sort of discussion on international tax for a while. Perhaps they are seeing more, reason around why should these transactions not go taxed in India, and they're expanding domestic concepts to kind of fit that. So that's another reason why maybe this move could be something more behind it. Not sure if it's entirely intentional at this stage.
Got it. Got it. So anyway, that was a surprising one. And anyway, there is something which the industry has been cheering for quite some time, which is actually the angel tax, right? So I think that was largely well received by most people in the market and the sector. And it's been a long-standing demand of the investors and also the startups. You want to just briefly touch upon that and your views on it?
Sure, that's the other one, which was, I think, everybody has been asking for a while, and we're very happy to see that come through, because the angel tax provision, and while it has gone, again, it doesn't show consistent tax policy from the government. Because if we take a step back and see where it originated from and what they did last year, to suddenly abolishing it now, it's a bit of a seesaw, because it was introduced originally about 12 years back, because there was fears that black money was being used to pay share premiums to like penny stock companies and launder black money into white. I think that was the main target. Unfortunately, it hit startups, and especially in the tech sector the most, because valuations are very astronomical when it comes to when you're trying to value a startup. It's a bit of an art. There's no science to it. Most of the time, the founder is sitting across with an investor and saying, "Okay, I'll give you 3x."
Can I just ask sorry, can I just interrupt you there? I mean, how will taxing that money for a higher value stop black money laundering, right? So I mean, black money laundering is a question of investigation, and there is KYC and record retention and other things. How will taxing high change that or prevent that?
They didn't have so what happens is there is another habit which our government unfortunately has, which when it can't regulate things, then they start taxing it at a high rate to try and disincentivize it. That's the same thing they've done with crypto, the same thing they're doing with gambling and gaming. So I think that seems to be a trend. Yeah, there's no accurate science as to why is it 30%. And because if you go under the Vivad Se Vishwas scheme, for example, right, the taxes and the penalties you pay for actually admitting any sort of taxes you haven't paid is much higher. But the intent was this, and it's kind of was brought on, and then it has been around all this while. And also, again, I mean, if there's any proved case of that not being the case, then just because you pay taxes doesn't make the money white or legitimate in any case. That's a separate problem in any event. But this was more like a presumptive sort of tax, saying, that lens of suspicion that anything you pay as a share premium has to be presumed to be like, if you're not paying fair market value according to what we think is fair market value or is measurable, then clearly there is something else going on and you have to pay us a tax on that, a significant tax on that. At least that was the thinking. And eventually, last year, they surprisingly expanded it to cover even non-residents as well. And they even then subsequently, there were a few other notifications where they said, oh, but if the foreign investor is a regulated investor, is an FPI, is registered with SEBI, is coming from certain countries, a whitelist, then this will not apply. And then suddenly now there is a full U-turn and they say we have removed it entirely, which is great, which is phenomenal for the startup sector, because like, as I was saying, if a textile company is valued at 3x, tech companies are valued at 10x. So I think, and that's where the justification for the premium and the valuation, it really hurt a lot more. So this, I think, will be a big boost to startups and companies in the sector. And there are a few, it's not just attracting investments, it's a whole bunch of other things we'll speak about, which I think will help on the corporate side as well in terms of, convertible instruments or anti-dilution rights. I think those are things which will become much, much easier, which were quite a pain point in most transactions in India for the last decade.
I mean, I think as you rightly said, it's definitely, literally these two were these two things that, one, I think a lot of foreign companies are cheering for. The other, a lot of Indian startups are cheering for, are actually U-turns, right? I mean, policy decisions that we took, which now we are reversing. And essentially, I think, Maya, it's not a boost to, boost to the sector. It would have boosted like literally 6 years back. The government did not allow it to boost. Now they are saying it's not working, so let's just let go, right? So yeah, fair enough, fair enough. So I think, interesting perspective, Maya. So I think, coming to your, your favorite sector. I mean, I wish Jaideep was also here to talk about, I think, crypto and gaming per se. Are there anything specific that you would like to touch upon in the specific sectors?
Yeah, so a couple of things when it comes to crypto and gaming, right? I think in terms of what does this budget do with respect to these two activities? So if we look at some of the, so there are two ways in which to look at this. One is from the operational perspective and second is from the financing perspective, right? Now, from an operational perspective, if we take both these sectors, of gaming, for instance, the GST is a high 28%. In terms of income tax, we are at a 25%, 30% still on the income tax side. Now, that's not the most favorable regime to be operating out of. With respect to also past sort of services that have already been rendered, we have a Supreme Court ruling that is pending, and that's a huge sort of sword hanging over everybody's head because of the uncertainty it causes. We also have, and I think maybe you could touch a little bit on the regulatory side and the current situation on gaming before we kind of get into whether it still makes sense to be in India or outside from an operational perspective.
I mean, look, I mean, it's not just about gaming, right? I mean, if you're any intermediary from a pure content perspective, whether you are an app store, whether you're a social media company, it just makes a lot of sense to operate from abroad due to various things, except for payment related things, right? So when you especially operate a B2C space, still Forex payments in India, you don't have that many options for payment. For instance, you cannot expand a market in India with just credit card as a payment option or international debit card as a payment option if you want to facilitate international trade, right? The cross-border strength of UPI, despite the fact that we have some bilateral arrangements with countries for launching UPI, it's not fully unleashed its potential. So given that circumstances, still, if you are a B2C company, purely from a payments perspective, in terms of Forex laws, in terms of efficiency of payment, in sort of chances of failure in terms of the market that you want to cover. If you are into local gaming, it still makes sense to actually do it in India, unless you are taking the benefits through an app store, right? If you're operating on an app store, one of the major app stores of any of the platforms, then you can also make use of their payment facilities and other things that they provide. But other than that, it makes sense for you to operate from India due to this perspective, despite the fact that there is actually a tax loss. But anyone would like to grow their customer base and have more customers. rather than just be so spread thin and operate from outside. But purely from a content perspective, purely from oversight perspective, etc., it's much better to operate from outside. So it's a mixed bag, Maya. So I don't think there is any, unless you're operating, let's say, in the crypto space. If you just, which has got clearly much more bigger hurdles to talk about, the actual issues with respect to operating a bank account, you don't know when you're going to get a notice because someone did something somewhere, right? So that sort of uncertainty, unless you're facing, it still makes sense for you to cover a larger number of user base, etc., if you operate in India, right? Or have these arrangements, some of these arrangements with, as you know, there is a new model that RBI has come up with called the PACB, the cross border. That also has not taken off in the same manner that we expected. There are many licenses are pending. There were many ifs and buts with respect to that model. Once that maybe takes off, I think probably we'll have a much better situation. But till now, it's still some of these factors, especially the payment factors, forex factors, are forcing many of these companies to still be in India.
Yeah, and I think you're absolutely right, Nikhil. Despite that, some companies have still chosen to be out where, like you said, the requirement was not to really rely on those payment rails and come to India to expand the user base where they're happy with the credit card base. I think they've continued to be outside. And they've continued to be outside despite, I tell you, certain challenges, right? So in the pre-budget regime, from a tax perspective, there was actually a few negatives for being outside of India. See, what in India, you have to pay GST, you have to pay the income tax, and the positive is, like you said, you get access to a larger user base, and you're able to expand your business by using larger payment rates. But when you're offshore, the few downsides where you still have to pay an equalization levy. So you still had to pay a 2%, which, like it or not, a 30% tax on a net profit, you need a 20% margin to match a 2% on gross. So that's roughly the math, right? So and not every, so even whether you're profitable or not, you have to pay the 2% levy. The GST really didn't change. In most cases, the GST applied except in certain situations. So that really wasn't much of an arbitrage. What really was an advantage from a tax perspective, still being outside, was being able to, the enforcement risks were a little low. The chances for sort of raids and any sort of harassment, if at all, was much lighter because you were outside. They had to follow procedures in terms of issuing notices, summons, etc. So you weren't usually so that offered some level of protection and comfort, and not being on the ground here in India. But nevertheless, there was a double tax cost because this 2% levy was not a creditable cost in most countries. So you still had to pay taxes, and there was, unless, see, even if you had a PE in India and you pay taxes, you can still take the full credit of it and you can offset it against your foreign taxes. But whereas a 2% levy wasn't. So
how much time will it take for you to do that, but?
I mean, that's another challenge. Yes, practically speaking, depends on which country that they have to go and claim it. I think claiming refunds from India.
And also the question is, Maya, if I understand correctly, the biggest problem with, is not sometimes the actual determination of whether you have a PV, PE or not. It's actually the question of what the attribution is.
Yes.
Right.
Correct.
And if given a chance, a tax department, they will try and cast a very wide net and try and cover as much as revenue as is possible to attribute from a place like India, which means that you will get a notice, you will have to pay it up and then, challenge it. And, and if I understand correctly, if you challenge it, then you can't offset it, right? So,
yeah,
or am I wrong?
No. So I think you're right. So I think, see, the challenge was that if you are based here, then of course, if you have a PE, then they would, instead of just the income attributable to Indian operations, they will typically say the global income, we have a claim on a portion of it and you have to pay 40% of that. So it's because of such expansive measures and tax terrorism that sometimes it's not an advisable move to have a PE in India because it leaves you open-ended for that. The other alternative of having a presence, and which many companies have done, is have a low risk distributor model where you put a company instead of a PE in India. But there also, it's not like the costs do go up. There is a transfer pricing cost, there is a margin you need to maintain, there is a tax cost on that, there's a compliance cost, there is a people cost. So it's not really the easiest way to do it. And so despite these advantages and because of these pros and cons, I mean, there are some people who have come to India, many who have stayed out. And now with the equalization levy going away, I mean, I think it's much more easier. The scales are tilted in favor of being outside of India. And in fact, if for companies who are finding it challenging to operate in India, I think it's maybe that merits consideration as to whether on the pros and cons it makes sense to be outside of India. And like I said, the overseas investment.
And Maya, just for everyone's benefit, right? We are just talking about digital, right?
Yeah.
We are talking about digital. We are talking about digital services. That's one, right? But that is with the idea that, look, there won't be a PE unless you get caught up in a virtual PE situation, which could be pretty much everything, right? So if and from what we were discussing, it's likely that we'll move to a scenario where, instead of death and taxes are certain, death and PE are pretty much certain if you are in the digital space.
PE or royalty or FTS. So the thing is, the good thing that the EL did on the dispute side, to be fair, despite the ambiguity there are a lot of situations where, and I can tell you a couple of situations, like a gaming company, let's say in Gibraltar, right, or Malta, which has a treaty with India, let's say was paying EL. Would not have been, then it's very less. I mean, I know in some cases the tax department still tried saying that it is a royalty and instead of 2%, you should have paid 10%. That arbitrage was something they tried to do. But in most cases, SEP discussion, PE discussion, whether it's royalty or not, these discussions didn't come into the play, right? Now with EL going away, I mean, tax department is likely to bring virtual PE, SEP, attribution, FTS, royalty, depending on the facts of the case. I think they're going to always try and bring up these issues. So it's not like EL is gone and everything is hunky-dory. So we need to just watch out for the facts. And for certain specific sectors, for example, like crypto, it's typical for many exchanges or companies to be based out of BVI or Cayman, where there is no treaty. So you don't have the treaty protection to say, there is no sort of, you can't tax this without a PE, right? And EL was sufficient. You could say I've paid EL, I'm exempt from income tax. But with no EL today, then you're talking about SEP. And SEP is the virtual PE concept where the attribution is still very untested before courts. So all of these things can get opened up. So if we look at gaming versus, crypto versus some of these other industry specific practices, I think the outcomes are going to be very, very different.
Got it. So I think, somewhere I think I'm getting the feeling that at certain levels, probably an EL would have been a better one than if the idea was to go down the path of, a virtual P or a really expanded scope of P, right? I mean, that's what I'm sort of, but you never know. We never know what's going to come our way. And anyway, so, we'll trust our tax department to do the right thing. So I think so. Couple of things, Maya. So we are sort of moving towards a time, and we should also open up to see if there are some questions. But few things I just want to ask. I mean, are there any other bright spots for tech startups generally? I know that on the space there is a space fund which is there. So I'm not a fan of such funds generally. I mean, I'm not sure if it will achieve the sort of purpose. I mean, if you just remove the hurdles in the way rather than just create new funds and put government money itself, we'll find ways to operate, is my belief, because you need to qualify as a startup, and startup is another definition. It's very interesting. When government wants to tax you, it will create very wide definitions, but when the government wants to give you benefit, it will keep come up with very narrow definitions, and there is highly unlikely that you will become a startup. At least most of my startup clients are not the startup under their definition. So are there any other bright spot that you can think of?
There are a couple, but before I get into that, on that same point that you're saying, even courts have interpreted the principles of interpretation, which say that tax exemptions are to be narrowly construed and the other way around. So it seems to be the underlying thinking. But on the bright spots, yes, there are a couple, and there are a couple of sectors. And I think on the financial structuring side, as you said, we are closing time. So I will just quickly address those as well. So on the good side, the TDS on e-commerce transactions has been reduced from 1% to 0.1%, which is an important change because for multiple reasons, and it has been done for the right reason. So one is most of these e-commerce companies, the intermediaries, their margin is 1 to 2%. So when 1% was being charged as tax, and then whether you make a profit or not, and whether it was return of goods, etc., under the income tax side, it actually led to a lot of capital blockage, which was quite a pain point for a lot of the people in the industry. So this has been a long-standing ask. While we are all on board that transactions have to be tracked in the e-commerce space. I think a 0.1% is more appropriate considering the scenario, and this should actually enable more transactions and be less of a pain point. Otherwise, cash was getting blocked. And the reason that they have done this is they've said we wanted to bring it in parity with the offline regime, where if goods were sold in an offline setting, 1.1% TDS, TCS would have been collected. So I think that way offline online parity is another measure on which the pillar you were making representations for many years. So that was a good change that's come through. In terms of the financing, right, I think the whole capital gains regime has been sort of opened up. They have rationalized it. They have made some fundamental changes. And what this means is that, the other question for startups to consider is it making more sense to have a company outside of India for fundraising purposes? And like you said, we have gone a full circle now where for regulatory reasons or for financing reasons, companies went out of India. Now the capital market is booming in India and they want to do reverse flips and come back, and that has its own set of challenges. But still, I think for tech startups particularly that are looking to access finance, this is still something, externalizing is something that they do look at, and especially at this balance of from an ops perspective as well, whether it makes sense or not. I think yes, having angel tax removed is a big blessing. It makes it easier to raise financing in India. But when we look at abroad, there are a lot of getting investments directly from outside of India into a startup here also, is making sense, because some of the changes in the recent budget, for example, right, they have said all unlisted debt will now be treated as short-term capital gain and will be taxed at the maximum rate. Now, that sounds bad at the starting because it's like you're going to pay, a very high rate as short-term capital gains for any of these sort of redemption or transfers. But I don't think the government has fully overlaid this with how it interacts with the tax treaty. Because if we take a step back and look at tax treaties, what the capital gains article says, and see, typically for equity, there is not much benefit left anymore, because Mauritius and Singapore were changed. Netherlands is the only treaty that offers a little bit of benefit in terms of capital gains relief. But there are many treaties which say that if you are, if you are transferring a debt, unlisted debt instrument, the gains will individual category and therefore will not be taxed in India. There are many treaties which still say that gains from such transactions will be taxable only in a foreign country. And the good thing with that is earlier, prior to this change, it used to be a bit of a gray area. So if an Indian company issues an NCD and there is a redemption premium at the end of it, is it to be treated as interest or is it to be treated as capital gains? And there are many practitioners who have issued opinions on this. So now with this change, I think at least it's deemed to be capital gains. So it should be easier to claim it. But nevertheless, under the treaty, there is a separate definition of what is interest for treaty purposes, and courts have said the treaty terms will prevail over the domestic law definition. So I think case by case basis, there could be situations where it is zero tax, right? Because you are redeeming or you are transferring, or it's, the proceeds on the maturity of the instrument. Same way, there are certain instruments investors really like a CCD or a CCPS, for example, because it allows you, especially CCD, because it allows you to come in as a debtor. And if the company is doing well, you can convert it at a later stage at a preferable term and take equity instead in the company. So these sort of situations, again, if you have a CCD today, it's likely that it is treated as short-term capital gains under this regime. But there are ways around it. You can always convert it into equity and then sell it. You can take advantage of the holding period, claim a long-term capital gain benefit. So basically, if you sold a CCD, it's let's say 30%, right? If you convert it into shares and then sell it as 12.5% capital gain. So there are lots of arbitrages and opportunities to kind of leverage different instruments and see maybe, in certain circumstances, CCPS works better than some of these alternatives. So when we interplay with treaty and we have issues like indirect transfer tax issues, right, maybe bringing in a portion of it as debt or convertible instruments also makes sense. So there is a lot of things to explore on the financing side. I think this budget has made it a lot easier for tech startups to actually take money in India. Because of angel tax being removed, typically you have anti-dumping clauses, and you also, because when a company raises at 1,000 rupee valuation, and then subsequently the same year there is a down round because the economy has fallen, the difference at 700 rupees, let's say, the difference was sought to be taxed in the hands of the original investor. Tax. So all of those problems goes away. And even on convertible instruments, if you had a CCPS, you're converting 1:4. So then there are a lot of different cases saying that no, this is, you're actually giving up a share, CCPS in exchange for an equity, and therefore you have to like value it, and angel tax applies. So there were a whole host of problems. All of that goes away. So financing should become easier, more tax friendly and neutral in India itself. But of course, if you go outside of India, then none of this anyways matters. You don't even have you still have to deal with gift tax, you still have to deal with GAR, you still have to deal with MLI and structuring transactions, primarily not for tax purposes. So there is a lot more hoops you still have to jump. But yes, this budget, I think, is a step in the right direction, and this is going to give take the pressure off the suppressing the sector, the tech sector.
Yeah, so I think Maya, the takeaway of this is that you are a true advocate of these firms leaving India. I think that's a final note from you on this webinar, interestingly. But anyway, so I think we'll open up the forum for questions, right? So so if anyone has any questions, you can pose it over here. So there is one interesting thing which has come up here, is the fact that, look, there is a general question that's actually come from a lot of folks, and a lot of them were asking as well. A lot of my clients were asking before this. They're like, what are the few major points that you're seeing scrutiny on, especially on from the tech companies, right? So anything that you want to sort of ask, sort of comment on? I think there are a few questions also coming in.
Sure. I think some of the things we are seeing scrutiny on, as I said, is like GST is still something that there's a lot of notices still going out with respect to filing for OIDA. They're trying to treat offshore sale of, digital sale of digital goods as something which is actually a digital service that is being sold. So this could be in the crypto space, it could be in the, any other sort of digital goods space. And that's something, the tax base is a problem. Where they get stuck on, whether it's real money gaming or whether it is some of these aspects, is what is the tax base for some of these transactions. And the taxability of these digital goods is again an issue, because some of this actually can't be taxed unless there is a change to customs law. Because the way GST works is that you pay GST on import of a good when you pay customs. And under the WTO moratorium, electronic transmissions are, for example, exempt from customs. But interestingly, now we are getting into a world where not all intangible goods are electronic transmissions like e-books or crypto. Recently, there are things coming up even on intangible things such as carbon credits, for example. So where do these things stand? The other piece where we see on the tech side is TDS on crypto exchanges, for example, or TDS enforceability on offshore operators, whether it's in the gaming space, etc. Because what has happened recently is, it's a gray area. There is, people can take different positions. Courts have said different things. Market practice is very divided on whether non-residents should pay, withholding tax or not. But the fact of the matter is, recently one crypto exchange has gone ahead and registered for with the FIU on the regulatory side, and has also started discharging withholding tax. So that really changes things up in terms of, oh, this is very painful, this is difficult to comply, this is not feasible, right? If one company starts doing it, and some statements in Parliament have also been made to that effect, and increasingly changes are going in that direction. So I think these are the two trends I would say that in terms of offshore digital participants we need to be more aware of.
Got it. So I think there is a question on IFSC. You want to take that?
Sure, happy to do that. I think IFSC, so just to give you some context, IFSC is mostly focused on financial services. It is an SEZ. It is outside of India for FEMA purposes, for exchange control purposes. They're not really doing too much on the fintech side right now. There are a couple of crypto funds that they have launched through a regulatory sandbox. I think that's where we are with respect to IFSC. They do have a lot of tax advantages though, but I don't think, and it could help in pooling finance with respect to like tech and investments into India. So from a pooling vehicle or fund formation perspective, definitely it is showing a lot of traction. But not, and for large MNCs, they are also making sure that their financing companies are being set up there, where they can raise low cost finance at better rates, because the exchange control rates don't work there. And then they use it for financing their own company. So treasury companies and finance companies for large conglomerates are being set up in IFSC.
Got it. Got it. I don't see any further questions. So I think we can possibly conclude today. And thank you, Maya. I think there is a comment: while the equalization levy has been removed, section 10 subclause 50 of income tax, which exempted from equalization levy from, has also been removed. Does this mean there are other revenues to this, to tax non-resident companies that the government may explore? I think that's along the lines of what we discussed, right? So
yeah, so I think there is avenue. So what we can expect is 1050 under the Income Tax Act was introduced when equalization levy was also introduced, because they said if you're paying the equalization levy, then you are exempt from paying income tax. Therefore, no one can come and say that you don't have a PE, or additionally make a case that you also have a PE in addition to paying the equalization levy. But now that the EL has been rolled back, it made sense to also remove 1050 exemption. So going forward, the tax department can try to allege that transactions are subject to tax either as a royalty payment, or as FTS, or as creation of an SEP, depending on on the facts as to what makes best sense there.
got it. Got it. So I think that brings to the end of the session. So thank you, Maya, for doing this, and thank you everyone who attended. It's always a pleasure to do this webinars. So have a good night, everyone. Thank you.
Thanks everyone. Bye.